What if everything you've been told about digital ownership is a dangerous, comforting lie? What if the technology pitched to you as the ultimate democratization of assets, the freedom to own anything, anywhere, is actually the final stage of a plot to end private ownership forever? You think you own your house, your car, your savings. You believe your property rights are protected by law, by tradition. You are wrong. Because a financial elite has engineered a system of digital alchemy, so complex, so insidious, that it's rolling out right now, in the open, disguised as convenience. This system removes the democratic friction of ownership and replaces it with instant, automated control. This technology is called tokenization, and its success establishes the foundation for a two-tier society where private ownership is replaced by conditional access, enforceable at the digital level by unelected bodies. Your assets will cease to be private property and will become programmable privileges. This isn't about political parties or ideologies. This is about a small, insulated group of bankers and global bureaucrats who are building the perfect digital cage. And the cage is ready for us. I need to know, where are you watching this from? Drop your city in the comments. And if you're ready for the unfiltered truth about how your assets are about to be silenced, you need to subscribe. Because what you're about to learn changes everything you think you own. To understand the ultimate threat of tokenization, we have to go back to the original sin of ownership itself. For centuries, property was tangible. It was land, gold, or goods. If you held the deed to a house, that document was your sovereignty. If the bank wanted your property, they had to send people, change records, and follow a lengthy, visible legal process. The transaction was slow, expensive, and carried significant friction. This friction was, paradoxically, our protection. Then came the age of financial innovation. As assets became less tangible, stocks, bonds, derivatives, they became centralized. You don't actually hold a share of a major company. Your name is listed in a centralized ledger held by a trusted third party, like a brokerage. This centralization created massive efficiency, but it also created massive single points of failure, where a single institution controlled the record of your wealth. This structure of centralized financial control reached its inevitable, destructive peak in the 2008 financial crisis. Wall Street bundled thousands of risky housing loans into complex bonds, stamped the highest safety rating on them, and sold them globally. The regulators, influenced and guided by banking lobbyists, called it financial innovation. They were creating a shadow banking system, a multi-trillion-dollar casino operating in the dark, with no oversight and virtually no rules. The moment the housing market fell, the entire system nearly imploded because the underlying ownership was centralized and corrupted. The problem, they claimed, was a lack of transparency and efficiency in the old system. The solution, they preached, was a completely new digital system, tokenization. They sold us the pitch that tokenization would finally give us absolute, fractional, immutable ownership secured on a blockchain. But that was the cover story. The real objective was not decentralization. It was perfect, permanent centralization of control. Sound familiar? They engineered a problem. Then they sold us a solution that fundamentally removes our sovereignty. What makes a tokenized asset different from a share in your brokerage account? A share is a record on a ledger. A token is the digital embodiment of the asset itself. It is the key, the deed, the contract, and the enforcement mechanism all rolled into one traceable digital wrapper. When your car, your house, or your stocks are tokenized, they exist only as code on a digital infrastructure. This structure creates the perfect trap. But tokenization only becomes a true threat when it merges with the only force powerful enough to enforce its rules globally: programmable money. The architects of global finance looked at the system they saved in 2008, and they knew the patch was temporary. They looked at the next crisis, a potential $600 trillion time bomb in the derivatives market, and they knew they needed a permanent, instantaneous, and invisible bailout mechanism. They needed ultimate control over the flow of value. They had already created the digital asset platform, tokenization. Now they needed the enforcement tool, Central Bank Digital Currencies, or CBDCs. CBDCs are not cryptocurrency. They are central bank liability, money created and controlled by the government, implemented on a programmable platform. Unlike decentralized cryptocurrency built on trustlessness, CBDCs enforce trust through state power, making them the ideal surveillance tool. You won't believe the full extent of this collusion. The system is not designed to digitize your assets. It is engineered to digitize the rules governing them. Tokenization and CBDCs establish the framework for a two-tier society where private ownership is replaced by conditional access. This union of tokenized assets and programmable money is the heart of the darkness. It creates the permanent, hidden pipeline of control. Let me simplify it with a scenario. Imagine the U.S. Central Bank decides to implement a digital currency. Now, all your bank deposits are converted to programmable dollars. Your assets, stocks, bonds, real estate, are all issued as digital tokens. They are connected. Your bank account, your house deed, your car title, and your stock portfolio now exist as a single, unified, instantly traceable data point. This system operates globally, backed by the authority of the issuing central bank. This allows for the ultimate moral hazard. Because the token isn't just a record of ownership, it contains a set of enforceable instructions. Let's get specific because the numbers and the mechanics don't lie. 1. The instant fine. During the last global health crisis, major foreign banks faced insolvency. The U.S. Central Bank activated currency exchange mechanisms, pumping $450 billion in a single week to other central banks, bailing them out in the dead of night. With tokenized assets, the control becomes automated and instant. If a major bank or counterparty fails, the central bank could execute a smart contract that automatically liquidates a tokenized collateral pool, including perhaps a small fractional piece of your tokenized assets, to stabilize the system, all without your knowledge or democratic consent. They use complex jargon like liquidity operations to hide this audacity. 2. The expiration date and compliance. Programmable money allows for forced velocity of consumption. Tokenization extends this control to property. Imagine your house token has a hidden smart contract clause. If owner's mandated social or environmental compliance score falls below threshold X, a fractional property tax token is automatically transferred to the governing authority. The system is no longer taxing your property, it is taxing your compliance. This establishes a permanent digital surveillance grid over your physical possessions. 3. Global concentration. The financial sector is dealing in derivatives, a global web of side bets, worth over $600 trillion. This risk is too vast to contain under the old system. Tokenization centralizes the data of these derivatives, allowing the system to instantly quarantine or erase the risk posed by a collapsing counterparty. The cost of this stability? The ability of unelected authorities to unilaterally rewrite the ledger of who owns what, when. 4. The access lockout. The programmable nature of the CBDC and the tokenized asset allows for conditional spending. During a mandated crisis, the government could program your digital currency to be unusable for purchasing high-emission tokenized goods, like a specific type of vehicle or a high-consumption appliance. Your money is still there, but your property access has been revoked, enforceable at the digital level, bypassing traditional legal due process. This is not about breaking a law. It is about violating a programmable policy directive enforced by code. 5. The interest rate scam. This system provides a sweetheart deal to the financial elite. They get access to infinite digital money at basement-level costs, while you pay 20% on your credit card. This parasitic finance creates a one-way flow of your economic sovereignty. The true asset is no longer the house or the car. The true asset is the data stream generated by its tokenized ownership, which dictates the stability of the entire system. This is the final lesson in denial. We are trusting institutions that are built on borrowed time, funded by borrowed money, and sustained by borrowed legitimacy. They are playing for time, hoping the music doesn't stop on their watch. But the music is stopping. You feel it every day at the grocery store, at the gas pump, in the quiet anxiety that your future is being mortgaged for a present you never agreed to. They are hiding the greatest transfer of wealth and risk in human history behind phrases like digital transformation and central bank cooperation. Don't fall for it. The question isn't if the system breaks. The question is, what happens when the final, secret mechanism fails? The philosophical lesson is simple. We are trusting institutions that are built on borrowed time. The token is the ultimate vehicle for denial, allowing us to pretend we still own things, even while the system retains the master key. If you understand the gravity of this, you cannot stay silent. Share this video. Break the algorithm of complacency. Subscribe, because we are just getting started in exposing the truth. The countdown has begun. Are we wiser now? Or are we just walking the same path in better suits, carrying our new digital shackles?